There we go. Brandon, we're live. Welcome to the show.
Thanks for having me.
Absolutely. Well, with your very cool background, we'll get started. Now, Brandon, what makes you really unique is the fact that you've been a founder. You, I think, built a platform called Jozii, and you
hmm
raised over $500,000 for that. You had over 100,000 users, and you've also been on the other side of the table as an investor, as a mentor, as an advisor. If you could like run a really quick kind of summary of like the highlights of your career and what you're working on right now at LvlUp Ventures, that'd be awesome.
Yeah, so I've been in the startup and venture space. It's fastly approaching close to 15 years now. Um, like you said, I've been on the founder side of the table. I've been a financial controller for a high growth Bitcoin exchange in the early federal regulatory days of that space, which was super exciting and really lit my entrepreneurial bug. Um, since 2016, I've been on the investor side of the table. So I built a seed fund and accelerator out of New York City called Quake Capital, have close to 300 investments through that vehicle. What we built at LvlUp Ventures was partially it was to do something truly differentiated in this space. I think accelerators are important, but that turnkey one size, which doesn't necessarily fit all model, it's been rinsed and repeated since 2007. And just like anything in innovation, there's a need, even on this side of the table, for change. We're definitely heading into a completely different market nowadays. So what we've built at LvlUp Ventures, we have a direct uh, seed fund that focuses on mature seed companies that have entered the market with positive month-over-month momentum over the last 3 to 12 months. They're starting to think about their Series A. We take a roll your sleeves up approach to working with all of our companies. So we work quite closely once we make an investment to help really accelerate their growth and get them to a Series A raise within a 12 to 18 month period. This is all part of a bottom up approach that we take. So we have a large scout network that refers deal flow to us and nine other funding partners. We have our next up corporate innovation and acceleration programs, which aren't your typical turnkey acceleration model. We take a bespoke approach to taking companies post MVP to market in a meaningful way, where we have the option with these companies where we've built great relationships to invest at their seed. And then anytime we want to do any later stage follow-ons, or we see opportunistic Series A beyond deals that might not necessarily fit within our thesis, we have a large syndicate network that we run. So we very much stay busy, but part of our team's model is just working, like actually taking an active approach at helping these companies when the CEO is playing much more of a chief of everything role and less of a CEO that can truly step into the overall business development aspect of their company.
Absolutely. We'll get to what you're doing at LvlUp Ventures just in a minute here. But I want to ask you, you talked about Quake being based in New York City. I
Mhm.
think you've also done a couple of projects out of Los Angeles. Those are two major hubs, not just in the United States, but the entire world right now. I want to talk to you about how important right now in today's world is being in the right location for fundraising. If you're a young founder today and you're thinking about where to live, where to go, where to position yourself, would you still say being in a place like New York City, San Francisco, Los Angeles is pivotal, or do you think it's become less important? Do you think you could fundraise and build successful ventures outside of those hubs?
That is a hard question. Um, and I'll explain myself. So I think it's really important for anybody getting started in this space period, or if you're making a transition as a startup founder and trying to break into VC, it comes down to network. The startup space and ecosystem can be, very intermingled no matter where you're based. But there is something to say about having so many opportunities at your fingertips, being in these very vibrant cities where in New York, instead of finding one or two events going on a monthly basis, like, you have a lot at your fingertips. And not only to mention, you are in New York. You're in this incredibly vibrant city. Or if you're in, San Francisco, I would say out of the three, that represents much more of a bubble, uh, and a cluster where there's so much going on from the standpoint of innovation. More often than not, you see companies that are raising at much higher valuations, and they have a lot more investors at their fingertips. So you can absolutely operate and do a lot of things virtually. Um, but sometimes, you fit, like when it comes to breaking down doors, sometimes you physically have to kind of figure out, how am I going to get to this person? Like, how am I going to meet them one way or another without making it turn into something creepy? But um, I think it's important in the early days. I don't think by any means is it going to be the make it or break it aspect of your career, um, where you can't make it in a different city. The great thing about today is pretty much every large city within any state has innovation. They're doing something within this space, and then there's definitely cooler spaces that aren't San Francisco, that aren't Los Angeles, that aren't New York, that have a lot around corporate innovation, like Walmart's sandbox program. So there are a lot of things that are kind of sprinkled across the globe in general. So I think it's not as much of a must as it probably once was.
Absolutely. And then in your earlier intro, you mentioned at Level Up, you help founders. You get in very early. If you're a founder and you've been getting a bit of traction and you're still very early stage, Level Up is basically where you go. And you talk about preparing them for Series A, Series B, those later funding rounds. How do you go about preparing founders to fundraise and to talk to investors? And then what can maybe outside founders learn from that process? And how can they maybe apply it to prepare themselves, even if they're not in a program like yours?
So we absolutely have to, in order for us to be successful with this model and be able to scale in a meaningful way, um, we're not always solving all of the same problems from the value add in which we're presenting to companies. It's absolutely great, obviously, if we get into rounds like we participate in a $30 million pre-seed round. You don't see those as much, but that was the founder, stepping into something in a unique space where sometimes I would just qualify those as like the perfect world scenarios. Like, if I just raised $5 million, I could do all of this, I could scale here, but it's not always an option. So anytime you do see that, or people that really understand about fundraising, it's super helpful. But it does become one of those large sticking points. Um, the growth and the need for more financing, they a lot of times they go very hand in hand. So for us, I would say that the strategy is always tailored to fit that specific startup. I wouldn't qualify like any one processes to just be like, this is exactly what you need to do. I know that doesn't fully answer the question, but I just say the kind of the clear components of fundraising that we try to instill in our teams is one, you need to be consistent. So as a founder, you can get pulled out from staying consistent in your raise at critical times of your company's growth or things going on with the product. And one way or another, you need to stay consistent, or these fundraising rounds can drag out to be 10 months, a year, and often beyond that. Um, Another thing is, find, easier, simple solutions to actually segment investors out. A lot of people will spend way too much time looking at who you know on LinkedIn. Those are not what I would qualify as warm introductions because they're not invested in you. So you might want to stray away from spending 30 minutes to an hour to figure out how someone that may or may not know this person well enough can get you in the door. Um, and then another part, and I'll wrap it here, is it's two pieces. Casting a wider net. Don't stay hyper focused on VCs only. That is not the only game in town. VCs are often investing other people's money. Individual angels or high net worth individuals are investing their own money. If we're talking about pre-seed, seed, those are still the people, if they're relevant to what you're doing, that might spend more time as a strategic investor than the latter. And then the last part is with those individuals, because not everybody's a serial angel investor. A lot of people don't even list their angel investments on LinkedIn. Is I recommend doing what I'd call non-invasive outreach. Don't just come asking for a stranger that's not a serial angel investor for money, and this is the reason why you're so great and they should give it to you. But look for people with relevant positions that they would be accredited. They've held certain roles, and they're coming from adjacent, non-competitive industries. Something that they would clearly understand what you're doing. 9 out of 10 times, they're going to know that you're probably trying to position it for money. But if you get a higher response rate and it feels better on the other side of the table to not just have someone look at you like a check.
Absolutely. One of the things that everybody's been talking about is your due diligence process at LvlUp Ventures. So it's award winning. It's been mentioned a bunch of times. I mean, it's widely recognized as being one of the best in the game. What about it makes it so great? I mean, what about the way you research and what about the way you evaluate founders makes it so successful and such a good filtering process?
So I'm very much a person who likes to try to figure out and connect dots. Um, Nothing I would say from a standpoint of being in Fund One about our processes or our overall venture ecosystem is necessarily normal across the board, but we think very quickly and try to really stay on top of being innovative. So from a baseline, we actually have certain plugins customized and built into our pipeline that will save us because we're on pace to do about 7,000 deals through the pipeline this year. So that acts as a mechanism to save us time if something doesn't match up with our criteria, and it will place them in the appropriate bucket. Um, the next piece would be those corporate innovation and that next up bespoke accelerator programs. Those act as a great pipeline for us because more often than not, when you're doing direct investments, you're going to get on 4 to 7, sometimes more calls to come up ultimately with a decision to hand capital over to this team. And it's easy to do, a few calls, a half an hour each, and not really see that person at their best or worst time. So the magic from the accelerator standpoint is we get a really direct insight in seeing how these companies handle certain adversities or certain situations. We are able to build more trust through that. But what we also do through our normal diligence process through the direct investment fund is we have what this outstanding extended team to level up. So we try to find good people that want to learn the space of venture. They might have been in investment banking for 15 years. They might have worked for a couple of healthcare startups, but they essentially cover the gamut of the types of verticals and stuff that we look at. Um, so we end up getting quite a few people and experts in given spaces to get on calls with these companies before we absolutely make a finite decision on can we invest or not. Part of their due diligence process with that whole value add on the growth side is we look for customer bases that are going to be complementary to one another. That way, we can also save time by getting some of these companies connected together, strengthening their position by enabling them to share some pipeline contacts from their customer base.
Hmm. One of the, as I mentioned earlier, interesting things is you've fundraised as an entrepreneur. You're not just someone who's is a career finance professional. When it comes to the fundraising process, one of the most important things is being able to identify the right funds and investors to approach. You already mentioned a bit about how to reach out to them and how to tactically position yourself, but how do you also go about tactically identifying the funds and investors that are right for your particular startup at its particular stage?
So, from my opinion, this is not fully perfect. The big difference from the standpoint of an investor versus startup, if a startup's appealing to consumers or even a B2B to audience, it's much more relevant for them to constantly update their site or materials as things change. With investors, there's only so much data that you're able to extract online. Um, so I've had like a nice kind of list that has evolved since I've been on this side of the table, which has been super helpful. And any time that I've helped other portfolio companies raise capital, I'll keep those lists, have those running notes, but it's not a perfect system by any means. We will utilize PitchBook, we will utilize Crunchbase, and we'll try uh, to find the right ones that seem like they're going to get fit or do a search for relevant similar investments and investors that they're backed by, but it's not foolproof. And it would go back to part of my advice for fundraising, which is do not spend too much time. It's I'd rather reach out to someone and say it's not a fit or nothing at all than know that I spent 20 to 30 minutes to put this name on my list.
Absolutely. And then, as the last question, what are some mistakes that you see a lot of founders made, or maybe you've personally made, when it comes to approaching investors and talking to them and building relationships with them?
Oh my God, that list is monumentally long. There's been a few things. There's the trying to trying to be mindful from a valuation standpoint. Being too hell-bent on a valuation before anyone's committed to that round. That's been one thing. Spending, because this gets confused when someone's doing a safe or convertible note round, there's no true lead investor. So a true lead in a price round is at least putting $500,000 and they're actually valuing the company. Valuations at the safe and convertible note rounds are very much in the eye of the beholder. So I usually recommend having a range or something, in mind where you're not going to do anything to turn off the investor before you've had a chance to actually state your case and get your foot in the door. So putting valuations in the deck, sometimes that can be a turn off or a reason that someone doesn't take the conversation. Going crazy high with what you're raising too early when it's because you saw, and this is very common, you get them talking about how this similar company or this similar company raised a $50 million seed round back in whatever year, but they have zero insights on what the founder's background is often, surprisingly. There are zero insights about where that private company was metrics wise. So there's basically no insights of how did they get 50 million, but now this is the validation for you to raise 50 million. So a lot of times there's things around numbers, the valuation itself. Sometimes another common mistake is you start pressing investors with close dates before there's enough in your round to even validate that. And whether you're a VC, like whether you're a founder, you can utilize close dates to try and do whatever you can to push that, but there's only so much you can really push it. There's too many times that I've just seen those conversations completely go away because there was too much pushiness on that end.